This is the financial statement analysis. So this is our line, and we will introduce about the least hours or a tour follow 3 hours. So we will introduce about why we need financial statement, or we call it this financial reporting, and we need understanding what about the related users and around about the financial statement and how they make decision makings around the financial statement. And also important is we will introduce is about the basic understanding about the generalized accept as accounting information principle, and we will introduce some traditional assumption. There will be the almost part of this course. So that we starting. First of all, what is users about the financial statement? Uh, if we just only thinking about the regulatory, you can think about inside use of the info financial statements, and the general public is the outside, just read about the financial statement. The regulators is also need very is oh, you can think in the regulatory, they basically is the process of these components. So company management and board of directors is the regulator. They the other side is about the public. So the stockholders, or you can say they are the implied investor or bondholders, and including the bank, they will just give some credit. They will price in these companies, supplier, and leading institutions, employers, and regulators. Or regulator, maybe you can say this is the government. It's the same things. Okay. So how are they to use the informations about the financial statement, and that is how they make decisions and how to use this financial statement. So we talk about the users of financial reports and how they make the decisions based on the financial information. So first of all is about management. Maybe you can hear about CEO, COO, CFO, blah blah blah. They all about the just company the executive management. So very easy to understanding to why they need the financial statements because if you want they want measures their operating results and make understand the financials the situations, and they want to plan the future business decisions. They all need understand the company's financial situations, how to performance or evaluate the others, the decisions, so on. So, and next is about the director, border of the director. You can think in the director is the supervisor about for the management. So if the management is doing well, director maybe decides and give them more bonus. But if the management doing is awful, maybe director won't give some punish or just fire them. Okay, so directors also need to understand what's the company's financial situations, how to measure them, and then decisions the management is the stage or hire someone new. Okay, so these two about management and the border that we call the insiders, and someone is outside or we can publishers. the users of the financial report. The stockholder maybe is we can be the use we can be the stockholders, uh, because we can just take some your savings or your money to buy some company's stock in your stock exchanges, right? We also want to invest in the stock market. So broadly, including the current and prospective investors, will all around these users type. And the investor use the financial statement information to understand the company's operating performance and the profits earning distributions, like the ROA, ROE, earning per shares. Some of you maybe you heard about that. And formulate the investment strategy. You want to invest in or not, buy the stock or not, somehow. And next is about regulators authority. Basically, is the government. So government is the supervisor and examining whether the company's operations operators in compliance with laws and regulations, and to assess whether it is meeting the tax obligations under the tax code. Yeah, so this is about the government, its character, and then what they do and their decisions. Suppliers, um, the mm, the supplier is the other company, right? They will influence on extend trade credit or continue to supply their goods and service for our main companies. So they also need to use the financial information. And the customers, if you want uh, purchase their product or service, and maybe you will reference the company's the informations about the finance. Okay, these two types of users are very maybe more similar. Okay, the final is employer and the lobby unit. When the employer or lobby want to negotiation or bargains their wage level, they need to measure their work result or performance. Then the financial statement can provide to understanding they provide the information to understanding the company's the profitably and prospect, and can help them to dictate the bonus payout and help them to negotiation their higher provide their revenues or salaries. Uh, salary, not revenue, sorry. And final, uh, this is some type about the use for the financial stable around that. But maybe I just missed someone. But I will introduce the importance the users of the financial report. Then we move on to the next topic. The formal process of developing the accounting principle are extinct today in the United States began with the Security Act of the 1933 and 1934. Prior to this law, the New York NYCE, New York Stock Exchange, which was the established in 1792. Yes, so long about that was the priority mechanism for exhibitions specific required for the disclosure of financial information. These requirements could be described and minimized and only applied to corporations. Was Who was the share well listed on the NYSE? So we can find the prevailing views of management was that financial information was the management use it. Then the 1929 stock market crash happened. So somebody calculates that the main reason is the stock market crashes was substantially influenced by the lack of adequate financial important requirement to the investment and the creditors. So on, the 1934, the SEC, Security Exchange Act, intended to regulate security trade on the national exchanges, and SEC, Security and Exchange Commissions, was created. Recently, the SEC issued a relationship SX, which describes the primary formal financial disclosure requirements for companies. The SEC also issued a financial reporting release (FRS) that's pertaining to financial reporting required. Regulation SX and FRS are part of GAAP and are used to give the SEC's official positions on the matters relating to financial statement. The formal process that exists today is a blend of the uh, private and the public sectors. A number of the parties of the private sector are playing a role in the development of GAAP. The as the AICPA, America Institution of the Certified Public Accountant, and FASB is the Financial Accounting Standard Board, have had the most influence. AICPA plays a very important role in shaping GAAP, but the accounting principle is very complicated. So on, they publish so many important documents between 1939 to 1973, but still AICPA still underwent several reorganizations, and finally in 1972, the Spectre Study Group of the AICPA recommends another approach, the establishment of the Financial ASB Board. So that is the history about the AICPA and the FASB. This slide illustrates the structure of FASB. You can find the structures it's very little complicated. The reason because they want to relate the large number is designed into the opt-in representations from the wide group of interested parties, and also the member from the different organizations. Uh, it totally have a 9 organization. They are AICPA and Financial Executive Institute, the Institute of the Management Accounting, Financial Analyst Foundation, and the American Accounting Association, the Security Industry Association, and the three non-profitable organizations. So the 9 organizations members also group occurs to the FAF, govern the FAF, and they appoint simultaneously about the FASAC and the FASB, and the FASB is advised to the FASB. So this this design makes sure everyone about related member and also coordinating to this FASB. Okay. So what is the work to the FASB should do? Uh, Basically, is the pronouncement for a pronouncement about the FASB. The first is the SFAS, Statement of Financial Accounting Standards. This statement establishes GAAP for the specific accounting issues. SFAS are part of GAAP unless they have been superseded. And second is the interpretations. These pronouncements provide clarification to privately issued standard, including SFAS and APB opinions and accounting research bulletins. The interpretations has the same authority and require the same majority vote for passenger as standard. A supermajority of the five or more of the seven members. Uh, Interpretations are part of GAAP unless they have been superseded. The third is the technical bulletin. These bulletins provide timely guidance on the financial accounting and the reporting problems. They may be used when the effect will not cause a major change in accounting practice for a number of companies and when they do not conflict with any board fundamental accounting principle. Technically, bulletins are part of GAAP unless they have been superseded. Statement then the number four, finally the final pronouncement. Statements of financial accounting concept SFASC. This statement provides the theoretical foundations on which is based GAAP. They are the output of FASB's conceptual framework project, but they are not part of GAAP. The FASB standard setting process, including aspects of accounting theory and political aspect. Many organizations, companies, and institutes have input into the process. Some input direct toward having a stand less than desirable in terms of strict accounting perspective. Often, the result is standard that not the best representation of economic realities. The concept framework of accounting and reporting was an agenda of the FASB from its inception in 1973. The framework is instituted to set forth a system of integrated objective and underlying concept that will serve as a basis for evaluating extreme standard of the financial accounting and the reporting. Here is all the financial framework project issued by the FASB, seventh concept statement here, but we only introduced the statement 1, 2, and 5, 6, 7. The number 3 statement is replaced by the 6. And number 4 statement is about NGO. This rare related about market, so we skip that. And if we're ready, then we just continue move on to the introduce the statement one. Concept statement number one, issued in 1978, deal with identifying the objective of financial reporting for business entities and establishes the focus for subsequent concept projects for business entities. Concept statement 1 pertains to generate proposed external financial reporting and not restrict to financial statement. The following is the summary of the highlight of the concept statement number one. So first of all, financial reporting is instituted to provide information useful in making business and economic decisions. Second, the information should be comprehensible to those having a reasonable understanding of business and economic activities. This individual should be able to study the information with reasonable diligence. Then the third point, financial reporting should be helpful to use in assessing the amounts, timing, and the uncertainties of future cash flows. Number four, the primary focus is on information about the earnings and its components. Number five, information should be provided about the economic results of an enterprise and the claim against those results. The SFAC concept framework number 2 statement is issued in the May 1980 and examines the characteristics that make accounting information useful for investor, credit, and similar decisions. Those characters of information that make it describe communities can be viewed as a hierarchy of qualities, with understandable and usefulness for decision making of the most importance. We have the three principle here. One is relevant. Second is the relatable. That's the primary principle. And also we got extra. We can just the other principle is about the comparability and including the consistency. We talk about the primary qualities principle first. Make accounting information used for the decision making to be relevant. The information need to have predict and feedback value and must be timely. To be reliable, the information must be verifiable, subject to representations, fairness, and neutral. The compatibility, which including the consistent, as we said that before, institutions with relevance and reliability to contribute to the usefulness of information. The heuristics include two consistencies. First, to be useful and worth providing, the information should be have benefit that exceeds its cost. Second, all of the qualities of information shown are subject to mandatory threshold. SFAC 6, which replaced number 3, and we talk about that in the 1985. And number 6 defines the 10 interrelated elements directly related to measuring the performance and the financial state of an enterprise. The 10 elevators are defined as follows. these we talk about that the asset, liability, equities, and we know the equity is equal to the asset minus liability. Number four is investment by the owner, distribution to the owners. Six is expensive. Seven is gains, and eight is the losses. So what are they? Okay, the first about asset. Assets are profitable future economic benefit, obtained or controlled by the particularly entering as a result of past transactions or event. Liabilities that are a profitable future subscribed of the economic benefit arising from present obligations of the practical entering to transfer asset or provide service to other entities in the future as the result of past transactions or events. And equity. Equity is the residual interest in the asset of an entity that remains after deducing its liability. So there's formation formulas like this one. Number four, investment by the owners. Investments by the owners are increase in the equity of the particular business enterprise, resulting from the transfers to the enterprise from the other entity of something of value to obtain or increase ownership interest or equity in it. Assets most commonly received as investment by the owners may also include service or stratifications or conversions of liability of the enterprise. And it's number five, distributions to the owners. Okay, is the description in equity of a particular business enterprise resulting from the transferring asset, rendering service, or including liability by the enterprise to owners. Distributions to the owners describes the ownership interest or equity in an enterprise. Number six, comprehensive income is the change in equity, or you can say the net. This equity you can say the net asset of a business enterprise during a period from the transactions and other events and circumstance from the non-owner's source. It includes all changes in equity during a period except those resulting from the investments by owners and distributions to the owners. The seven is about the revenues. Revenues are the inflows or other enhancement of assets of an entity or settlemental of its liabilities or combinations of both. From the delivering or producing goods, rendering service, or carrying out other activities that constitute the enterprise as an ongoing major or central operations. That's revenues. The eight expensive it are the outflows or other consumptions or using up of assets or incurrence of liabilities or a combination of both. From the derivatives or producing goods, rendering service, carry out other activities that constitute the enterprise ongoing major or central operations. Nine is gain and increasing equities from the period of health or in incidental transactions of an entities and from all other transactions and other events and circumstance affect the entry during a period except those that result from revenues or investment by owners. Number 10 is losses. Losses are descriptions in the equities from the peripheral health or incidental transactions of an entity and from all other transactions and other events. And the crucial statements afraid the entries during the period except those that result from the expensive or distributions to owners. Yeah, that's all about the number six. We know some detail about this one. The uh, SFAC number four, as I said that before, is about the NGO, non-business organizations. That's including the formula budget and donor restrictions. The type is indicated not ordinarily related to the competitions in the market. So we skip the number four, statement four here. SFAC's number 5 issued in the 1984 that indicates in order to be reorganized and items should meet four criteria subject to the cost-benefit constraint and military threshold. The four things is the definitions, measurability, relevance, reliability. Okay, that's four things about that. So about the definition is all write downs on the slide, so I'm not just read again. So about the concept, this concept statement identified five different measure attributable recently using in practicals and recommend the computations of the full set of financial statements for a period. The following are five different measures testable currently used in the practice. Okay, the five things is here: heuristical cost, current market value, net realizable value, present value of future cash flow. This concept statement probably accomplish little relating to the measuring attitude because a firm constant positions on the recognition and the measurable could not be agreed upon. It states uh, rather than attitude to select a single attitude and force change in practice so that all classes of assets and liabilities using that attitude. These concept statements suggest the use the different attributes will continue. So SFAC number 5 recommends that four set of the financial statements for the period should show the following. One is financial position at the end of the period. Second is earnings, or we can say that as a net income. The third is comprehensive income, or we can say total non-owners change in equity. The number four is the cash flow during the period. Number five is the investment by and distributions to the owners during the period. At the time SFAC number 5 was issued, financial position at the end of the period and earning or financial statement being present. Comprehensive income, cash flow during the period, and investment by the distributions to owner during the period and the financial statement that have been subsequently developed. All of these financial statement will be covered extensively in this course. So we can talk about downside is about SFAC number 7. It's issued in February 2000, provides a general principle for using present values for accounting measurement. Is described technically for the estimating cash flow and enter rates and applying present value in measuring liabilities. So this is the why it's crucial. Okay. Overall, the FASB concept framework for the accounting and the reporting project represent the most extensive effort undertaken to provide a conceptual framework for financial accounting. Potentially, the project can have a significant influence on the financial accounting. In 2000, GAAP was generally considered adequate, but subsequent financial fraud indicate lead to a series of major reforms in regulations, accounting principles, and corporate governance. The annual schedule went public within a month. Uh, Aaron declined bankruptcy. The Aaron bankruptcy probably received more publicity than any prior bankruptcy in U.S. history. This attention was influenced by the size of Aaron, the role of the editors, the financial loss of investors, and the losses sustained by Aaron employees. Many Enron employees lost their jobs and their persons as well. There were approximately 2 dozen guilty pleas or convictions in the Enron case, including Kelly. And the other case, the 2002 WorldCom scandal announced. So these two events or two financial fraud cases gave rise to the Sabin-Oxley Act. Sarbanes-Oxley Section 404 requires companies to document and evaluate interval control over financial reporting and assess their effectiveness. Management must accept responsibility and issue a writing assignation. The SEC mandate an annual report that states management duty, identify the evaluation framework, state where controls are effective at the year end, disclose monetary weakness, and note that editor's report. Editors must opinions on the associations. The Sabin art, I just said that SOX somehow, strengthens independence, and Krubin's pre the Sabin art relies on the editors for complex accounting decisions. Okay, let's take a 5 minutes break. You can drink water, go to the bathroom, and when you return and the music is continue, please think about this quiz. What the consequence of the non-standard financial statement that doesn't adhere to accounting principles? Which of the following option is incorrect? A, B, C, D, we have 4 options. 3 is correct, 1 is incorrect. Please choose that incorrect option. Okay, you don't need to answer here. You please log in on the iLearning 2.0 and you answer this quiz on it. Okay, so if you don't have any other questions, just go on, and if you have some question, you can just type in on the discussions. Hi, welcome back everyone. I'm assuming you have thinking about this quiz, so that we move on to the next chapter. So this chapter we will focus on the two purpose. One purpose is of S counting assumption. The other one is about the S counting qualities principle. Okay. We here in this slide, this page, we talking about the purpose of accounting assumptions. It provides a framework for the preparations of standardized, reliable, and comparable financial report, embedding users, such as investor or credit, to use company financial information to make informed decisions. These assumptions help transform complex corporate economy activities into quantifiably and understandable as accounting information. By proving a clear timeline and logical framework, they facilitate the regular and systematic conduct of the company's operations and financial reporting. Here I must be clearly announced about that. The S counting assumptions or traditional assumption and the quality principle, they are actually my turn. I name it, I say it. But in fact, they may not be a clear classifications. So just this for easy to and smooth to talk about this topic. So I give the classification about assumption or principle, but you must be known understanding they are not very clearly classifications. So we have the four assumptions here. Let me introduce about them one by one. One is the business entirety. Second is a going concern, or we call it continuity. Three is a time period, and four is a monetary unit. Next page, uh, business entirety. So is the you can see the definitions on the slide, and basically the important things we give you example. An individual may own a grandson story, a farm, and a number of person asset to determine the economic success of the growth center story. They would view is the separately from the other results owned by the individual. The gravity story will be treated as a separate entity. So that's the you just thinking it's one by one, but one owner have a different store, have a different company, different uh, entirety. You must separate it to count it. Okay, that is the first assumption. The second is going concern. The going concern assumptions also same there's the definition on the slide, and I give you more just the example. Okay, so there are should the going concern assumption should be dropped. In such a case, the reader of the financial statements in institute in the liquidation values, not the value that can be used when making the assumption that business will continue indefinitely. If the going concern assumption has not been used for the particular set of financial statement because of the phase of the liquidations or bankruptcy, the financial statement must clear disclose that the statement well prepared with the view that the entire will be liquidated or that is a failing concerns. In this case, conventional financial report analysis will be not applied. Many of our present financial statement figures would be misleading if it were not for the going concern assumption. For instance, under the going concern assumption, the value of prepaid insurance is completed by spreading the cost of the insurance over the periods of the policy. If entitled were liquidated, then only the cancellation's value of the policy would be managed for. Investments are basically carried at their executed cost. If the entire was liquidated, then the amount realized from the sale of the inventory in the manner other than those the user channel usually would be substantially less than the cost. Therefore, to carry the inventory at cost would fall into the regulates the loss that is represented by the difference between the liquidation value and the cost. Time period basically is the trade-off between occurrences and the immediately issues. The only occurrence way to accounting for the successful or failure of an entity is to accumulate all transactions from the opening from business until the business envelope liquidates. Many years ago, this time period for reporting was acceptable because it would be feasible to the account for the dive up while the remaining at the completions of the venture. Today, the political business has a relatively long duration, so it is not feasible to wait until the business liquidates before accounting for the successful or failure. This presents a problem. Accounting for the success or failure of the business in midstream involves in occurrences. Many transactions and commitments are incomplete at any particular time between the opening and the closing of business. An attitude is meant to eliminate the incurrencies when statements are prepared for a period of time short or an entire lifespan. But the occurrences could not be eliminated completely. For example, the entire political current accounting receivable at the amount accepted to be corrected. Only when the receivables are correct can the entire account for them accurately. Until receivables are correct, there exists the possibility that correlation cannot be made. The entity will have outstanding obligations at any time, and these obligations cannot be accurately accounted for until they are met. An example would be warranties on product sale. Entitled may also have a considerable investment in the productions of investors. Usually, until the inventory is sold in the normal course of business, the entities could actually account for the investment in inventory. With the time period assumptions, we acceptable some inaccuracies of accounting for the entire short of its complete lifespan. We assume that the entirety can be accounted for with reasonable accuracy for a particular period of time. In other words, the decision is made to accept some inaccuracy because of the incomplete information about the future in exchange for more timely reporting. Some business select an accounting period known as a natural business year that ends when operating on the low ebb in order to facilitate of better measurement of the income and the financial position. In many institutes, the natural business years of the company ends on the December 31. Other businesses use the calendar year and those end the accounting period on December 31. Those for many companies that use December 31, we can tell if December 31 was a select because it represents a natural business year of or if it was selected to represent calendar years. Some select are 12 months as counting period, known as a fiscal year, which closes at the end of a year other than December. The accounting period may be shorter than a year, such as a month. The shorter the period of time, the more in a currency we particularly accept in the reporting. Military unit. So we have the major logo or trying to some information into our financial report. We need to consider about the different things such as terms about the five car, one factor, or 100 products goods. This type of reporting will not be very measurable. The most common example is inflation and currency exchange. So we talk about exchange, currency exchange more. Different countries call their monetary unit by the different names. For example, Japan use the yen. The different countries also attach different value for their monies. $1 is not equal to 1 yen. Those financial transactions may be measured in terms of money in each country, but the statements from the various countries cannot be compared directly or add together until they are converted to common money unit, such as US dollars. For Taiwan, we also must use be the Taiwan New Taiwan dollars or the renminbi somehow. The other example is about inflation. In various countries, the stability of the monetary unit has been a problem. The loss in value of money is called inflation. In some countries, inflation has been more than 300% per year. In countries where inflation has been significant, financial statements are adjusted by the an inflation factor that restored the significance of the money as measured unit. However, a completely acceptable restorations of money as a measuring unit cannot be made in such case because of the problem involved in the determining and a current index. To indicate one such problem, consider the price of the car in 2001 and in 2011. The price of the car in 2011 would be higher, but explanations would not be simply that the general price level has increased. Part of the reason for the price increase would be that the type and the quality of the equipment changed between 2001 and 2011. Those an index that related the 2011's price to the 2001 price is the mixture of infractions, technically advancement, and quality changes. Okay, then we introduce about the S-counting assumption. Then I will introduce the principal S-counting qualities for you. But remember, again, I notice again, the principle of S-counting quality and the S-counting traditional assumption not very clear classification. That's only I name it. Okay. So we have five core principle here. One is conversion, two is matching, the three is consistence, the four is full disclosure, five is military. So then we move on to the first about the core principles of the accounting quality. Conservatives apply when several well-supported measure options exist. Choose the one that yields the less favorable effect on currency net income and the financial position. It isn't permission to understand the arbitrary write-down are improper use including violation inventory at the lower of the cost or market. Write down absolute stock recommendations likely lost on long-term contract. Apply continued overhead to inventory and using prudent warrant expensive estimate. The revenue realization concept involves when the recognition revenue as accounting needs the related concept that address when to reorganize the cost associations with organized revenue. The matching concept. The basic intent is to determine the revenue first and then match the appropriate cost against this revenue. Some costs, such as the cost of inventories, can be easily matched with revenue. When we sell the inventory and recognize the revenue, the cost of the inventories can be matched against the revenue. Other costs have no direct connection with revenue. So, some systematic policy must be adopted in order to allocate those costs reasonably against the revenue. Examples are research and development cost and public relation cost, both of which are charged off in the period incurred. This is inconsistent with the matching concept because the cost would benefit beyond the current period, but it is in accordance with the concept of conservatism. Consistence, well, the definition is on the slide, so I want to talk you the many accounting methods could be used for any single item, such as inventory. If inventory were determined in one period on one basis and in the next period on the different basis, the resulting inventory and profit would not be comparable from the period to period. So we need to adjust about that. Entire sometimes need to change particularly as a counting method in order to adopt to changing elevators. If the entire can justify the use the alternative as counting method, the change can be made. The entity must be ready to define a charge, a responsibility that should not be taken lightly in view of a liability for misleading financial statement. Sometimes the change will be based on the new accounting phenomenon when an entity make a change in accounting method. The justification for the change must be discussed around with an explanation of the effect on the statements. Full disclosure required reports to include all facts that could affect and inform the reader's judgment. If a company departs from FASB guidance, it must reveal departures and explain why. Disclosure can take several forms: parenthetical notes, supporting schedule, cross-reference, and expected footnotes that the company describes pensions, long-term leases, and bond provisions. Because financial statements are summaries, not everything belongs on their face. Too much details can confuse and even breach the principle. The aim is a reasonable compensation that highlight material matters. Applying the concept is difficult amid complex business and rising publication expectations, and as contents are often sourced for in the careful disclosures. Since disclosure depends on the professional judgment, disagreement about the sufficiency, particularly from the partial who success the loss and comment. The accountant must consider many concepts and principles when determining how to handle a particular item. The proper use of the various concepts and principles may be costly and time-consuming. The material concept involves the relative size and importance of an item to a firm. An item that is material to one entity may not be material to other. For example, an item that costs $100 might be expensed by GE, but the same item might be carried as an asset by the small entity. It is essential that the material items be properly handled on the financial statements. Immaterial items are not subject to the concept and the principle that bind as content. They may be handled in the most economical and expeditious manner possible. However, at the content face the judgment situation when determining maturity. It is better to err in favor of an item be maturity than the other way around. A basic question when determining whether an item is maturity is: will this item influence and influence the reader of the financial statements? In answer this question, the accountant should consider the statement as a whole. The subbing actor has military implications. The art has put demands on management detect and prevent military control weakness in a timely manner. To help management fully fulfill this responsibility, CPS are created a monthly key control process to assess and report on risk. When management find a key control that do not meet the required minimized quality standard, it must classify result as a key control exception. Some industry practice lead to accounting reports that do not conform to the general theory that underlie accounting. Some of these practices are the result of government regulation. For example, some difference can be found in highly regulated industries, such as insurance, railroads, and utility. In the utility industry, an aerolyze for the fund used during the construction period of a new plant is treated as part of the cost of the plant. The offset amount referenced as the other income. This amount is based on the utility hypothetical cost of a fund, including funds from the debt and stock. This type of accounting found only in the utility industry. In some industries, it is very difficult to determine the cost of the uh, inventory. Example including the meat packing industry, the flour industry, and the farming. In these areas, it may be necessary to determine the inventory value by working backward from the uh, anticipated selling price and subtracting the estimated cost to complete and dispose of the inventory. The inventory would thus be valued at a net realizable value, which would depart from the cost concept and the usual interpretations of the revenue realization concept. If if inventory is valued at net realizable value, then the profit has already being recognition and a part of inventory amount. The as accounting professional is making an effort to reduce or eliminate spe- specific industry practice. However, industry practice that depart from practical accounting produces will probably never be eliminated completely. Some industry have legitimate persistently that call for the accounting producers other than the commodity ones. When we talk about the industry practice, we have talking about the one approach and the two biases. So this approach is a transactional approach. Okay, the as content record only events that affect the financial positions of the entire and at the same time can be reasonable determined in monetary terms. For example, if the entire purchase maintenance and on the as count the financial position of the entire change. This change can be determined in monetary terms as the inventory asset is operating and the liability as count probable is incurred. Many important events that influence the prospect for the entire and not record, and therefore are not reflected in the financial statement because they fall outside the transaction approach. Uh, the death of the top executive could have the monetary influence on the future prospect, especially for the small company. One of the company's major suppliers could go bankruptcy at the time when the entity does not have an alternative source. The entity may have expensive loan strike by the employer or have a history of lobby problem. A major competitor may go out of the business. All these events may be significant to the entire. The, they are not recalled because they are not a transaction. When projecting the future prospect of an entire, it is necessary to go beyond current financial report. Some of the items not recorded will be disclosed. This done under the full disclosure assumption. And then we talk about the cash balances. Okay, the cash balances recognize revenue when the cash realized and expensive when the cash is paid. The cash balances usually does not provide reasonable information about the earning capability of the entire entity in the short run. Therefore, the cash balance is usually not acceptable. The third accurate balances. Accrued accounting record revenue when earned and expensive when incurred, embodying realized and imagined. Cash basis may be acceptable only when differences are immaterial. Some service firms adopt a modified cash basis that capitalizes long-lived terms. Accrual reporting requires period-end adjustments. Split prepared item between asset and expense. Accrual on unpaid wage as expensive and liabilities and define advanced correlations as unearned revenue. Those more complex accuracies portray performance and financial positions more fearfully than the cash basis and making time period reporting feasible. Here is an example indicate why the accrual basis is generally regarded as a better measure of the firm's performance than the cash basis. Assumptions 1. Sold merchandise inventory for $25,000 on credit this year. The merchandise cost $12,500 when purchased in the prior year. 2. Purchase merchandise this year in the amount of $30,000 on credit. 3. Pay supplies of merchandise $80,000 this year. 4. Collected $50,000 from sales. Accrual basis indicates a profitable business, whereas the cash basis indicates the loss. The cash basis does not reasonably indicate when the revenues was earned or when organized the costs that related to the earned revenue. In practice, the accrued basis is modified. Immaterial items are frequently handled on the cash basis, and some specific standard rules have allowed the cash basis. Since 2002, the FASB and IASB have pursued convergence, widely backed in the US when the SEC later proposed the roadmap requiring US firms to adopt IASB standards. Strong oppositions arose. The US still appeared likely to move toward international standards, though the method was unclear. In 2011, the SEC floated a counter statement. Over 5 to 7 years, use IFRS as a reference, keep enjoy MOU projects. Have FASB assess GAAP IFRS difference and IFRS fit for US market, and help develop IFRS while US GAAP remain under US regulation. Taiwan follow international financial reporting standards. This is the final slide of this section. Let's review the key points. We review the history of the development of US accounting standard and how GAAP has been refined those assistive developments. We introduce accounting assumptions and accounting quality principle and why they are so important. Finally, we discuss the current state of alignment between practice biases and the international accounting standards.